Negative visualization focuses on training the practitioner on the negative outcomes of realistic scenario to desensitize or create psychological fitness in preparation for real life losses, introduce feeling of gratitude over real thing or actual the practitioner has, right? So how do, why am I mentioning this? How is this relevant for trading? Well, when you trade, right, you have to go through both positive and negative scenario, right? Majority of traders do not know how to short the stock, right? 90% of traders, retail investors, do not understand how can you sell a stock that you do not own, right? So for that reason, it's very important to go through these scenarios, right? Let's say you think that this level will hold, right? Either 406 and 412. You have to decide what your target gain and what your stop loss, right? If you're a short-term trader, if market reverses, it is conceivable that the market can reach, at least retest 200-day moving average. We were there last week. It's reasonable to assume we can get to 431, right? Let's say you think that market is overreacting to the news and it will go higher. So you're buying at 412, right? Let's say you buy at 412 because you see the support, right? For short-term day trade, you think this or 406 level will hold, and you're targeting, 62% retracement, which is 20 points to the upside, right? So that's positive visualization. 9 out of 10 traders, that's what they're doing. They're looking at some kind of a support. Somebody on Bloomberg says, or CNBC, that market is overreacting. Potentially market can move 5%, and these are people saying that they are, have more experience than I do, right? So you listen in, you look at your support, you have your signals. Market is oversold by any stretch of imagination, so you're buying, and you only think about making 20 points. This is where the negative visualization has to take place, right? You have to determine position size. It's not so much as you're trying to figure out, prepare for the negative outcome. No, you just need to know what the position size is, right? So then that becomes, you see support is August low, right? We're within striking distance, 2% away from August low. That's your first level of support, right? Assuming this level, doesn't hold. So you can basically say, what? I'm comfortable with, that this level will hold. So my stop loss is, you're buying at 413, 406, 8 points, right? So you're risking 8 points to the downside. We might be there by end of today's session, right? Probably not, but maybe sometime next week. And you're not comfortable making decision when it's 1 or 2 days. So then you go back. The next level, if you break through the 406 level, well, there's a little bit support at 400, right? A little bit 400, but most likely we will revisit 390. And that is, now we're going back to end of July support, July high, right? Multiple times. So that's a much stronger support, right? Much stronger support, but you have to give yourself more room. And this is about 25 points, right? So you can say, you know what? I want to make 20 points, and I don't want to risk more than 23 points from 413 to 390, right? Support too. So that's your stop levels, right? So now you need to have a position size. I propose, again, make it process oriented, right? Part of the Stoic philosophy is that you derive pleasure, you derive satisfaction in the process, right? You live as, you can't become a Stoic just by listening to definition of negative visualization. This has to become internalized. The only way you can internalize, you do this every time, right? Once you do this every time, it will be kind of innate and built into your thinking process. So visual negative visualization, you basically 23 points, so $250, right? The goal is for any disciplined trader to always risk the same amount. Doesn't matter what you're trading. You can buy futures, you can buy Bitcoin, you can buy the most volatile stock, meme stocks, probably the most, no, not the most volatile, but Forex. Probably Forex is the most volatile, and futures, options on futures are the most volatile, instruments you can find, right? If you love volatility and you want things to move 100% up, 100% down, or 300% up, 300% down, there is appeal in that, no problem. But the risk should always be $250. You can buy the slowest moving asset classes, like, I don't know what the slowest moving asset classes right now, like prime rate or something like that, versus the most fast. But you always risking $250. What does that mean? Your position size has to adjust. If something has to move a lot, you trade small amounts, and if something moves slow, you buy larger amounts, right? So you have to accommodate for that. It cannot be always, I always invest $100. I invest $100 in penny stocks, or I invest $100, right? Because they're going to move in different percentages. You have to think about percentages. So if you're risking 8 points, $250, this is on a $10,000 portfolio, right? If it's $20,000 portfolio, it's $500, right? We're looking at 2.5%. So if you're managing 20,000, then okay, you can risk a little bit more, $500 or $450, right? Maybe you say, well, on larger portfolio, I don't want to risk, but it's always the same amount. So if you're risking 8 points, right, we're still concentrating on $250. If you're risking 8 points, then you can buy 3 times 8, $240, 30 shares of S&P. And if you're risking 23 points, then you can only buy 10 shares, right? That will give you $230. So you can see why negative visualization is so important, right? Because you can kind of determine your maximum, what your exposure is, right? So if this is what trading is all about, nothing else, right? A number of positions, right? Because you have 100 positions like this, and they're all selling off, right? Everything is, you can see Amazon is down, Apple is down, Uber is down, Nvidia is down, there's nothing, Workday, because of the earnings, is still up, but it gave up majority of its gains, right? A firm is down 20%. So everything is trading high correlation. It's just position size is different. So for that reason, it probably doesn't make sense to have Apple, Amazon right now, Uber, BMW, because they're all, excuse me, they're all selling off in very high correlation to each other. So 4 positions. I propose 4 positions, because this way you know that 4 times 250, maximum exposure is $1,000, 10%, right? You were, a lot of people were bullish going into this announcement. The idea is that we will at least retest or actually break through this downtrend, right? Break through this downtrend. So if you're bullish on this market, you're not alone, right? I would say 50% of the people probably bullish at this time. Then if the market, let's say, reverses and let's say it does drop, right? Well, the most you're exposed is $1,000, right? You will exit, if you have 4 positions at stop loss at 406, then you exit all 4 positions at 406, right? Let's say they're all bullish. If you have 4 positions at 390, you exit all of them. The biggest mistake, if you buy 30 shares of spiders, right? And let's say today market reaches 406, you think it's extremely oversold. You always reverts to its mean, so you're holding this position. And then next week it approaches 390. Then you have a dilemma, right? Now you have 4 positions, and they are down $500, right? What do you do, right? And that's where usually now you're down $2,000, 20% down on a $10,000 portfolio. What do you do, right? And that's very difficult to do because fight or flight response, right? An automatic physiological reaction to event that perceives as stressful or frightening, right? What is the trading all about? Especially, it seems like we are still trading in the bear market. You can argue whether we are or not, is to avoid this physiological response, right? A lot of people ask me, what is the trick to trading? What have you learned from trading in the bear market? My response is always, when market closes, I don't want to think about the market. I don't want this to become my personality, right? How do I do that? Well, you have to minimize this response, right? If I'm on the wrong side of the trade, I'm probably not happy. I'll be honest. But if I'm within 10%, then it's okay, right? I don't think about it, right? If I'm down 20%, then during the weekend I'm gonna spend time, thinking about, I thought Fed will pivot, it didn't pivot, you know what, you know, and et cetera, et cetera. So how many of you experienced this, you know, fight or flight response when you were trading, and how often do you experience it? That's the question. I'm gonna ask everybody. So type in yes or no. Ellen, Andre, Bruce, Byron, David, Don, James, Kevin, Leland, Mark, Mason, Michael, Nathan, Osama, Paul, Peter, Rick, Robert. We have a lot of traders. How many of you have experienced this fight or flight? All right, yes, yes. Okay, yes, we all did, right? And if you didn't, you probably just didn't trade long enough, right? Because the idea is that the idea is that you learn on my mistakes, right? If you learn on my mistakes and you can, you know, always have 4 trades, 2.5%, you always get out, you know, 10% is not a big deal. You can vary your card and you never experience it. There's very small percentage of people, less than 1%, can learn on other people's mistake. Majority of the people learn on their own mistakes, and then there's still a lot of group of people that never learn, right? So if you never learn, most likely sooner or later you stop trading, right? You stop trading because the pain kind of unbearable, right? The part of Stoic philosophy is that you use these physiological reactions, pain. I mean, it's kind of one way to describe it as pain, and you lean into the pain and you learn. You learn, your creative process gets kicked in, and then you find ways to kind of learn from your mistakes, you know. So hopefully we're all either learning on my mistakes, but realistically you're learning on your own mistakes. And as time moves on, you will realize that the only way to deal with this pain is to go through this calculation or some kind of calculations like this, and you want to internalize. It's not mental stuffs. It's you actually have to journal, right? The only way to internalize the information, in my opinion, is to journal. You cannot internalize information if you just, you know, have mental stuff. Why? Because just the human nature, right? We, at least my belief, I could be wrong, but my belief is that you have to journal to internalize the information. So it becomes a second process, because otherwise, you know, you do it 9 times and then on the 10th time you don't do it, and that's where your losses exceed your gains. So you have to journal. You have to document all your trades, right? Document all your trades in your journal. And you have to grade yourself, right? Objective information, right? Grade yourself, and you know, you put A and B if you follow the process, right? You're a Stoic philosopher. You practice Stoic. You don't just listen definition of Stoic, but you practice. Then you're A and B. If you're not a Stoic trader, then you put C and D, right? Because, you know, sometimes the outcome is more important than the process, right? And the idea of another, you know, Stoic concept is, I'm reading these Stoic books, love it. Dichotomy of Control, right? Another Stoic concept, extremely important to trading, which again, this was done 2,500 years ago. This is not something I came up, or this is not emotional intelligence that, you know, we started defining 20 years ago. This is engraved in our DNA, right? This is engraved in human, you know, mentality. Is separating things that are within your control and things that are outside of our control. You know, here's an example. You know, things that are within your control, your thoughts and your actions, and things that are outside of your control is everything else. How does it translate? Outcome of the Jackson Hole meeting is outside of our control, right? Market could have rallied, market could have sold off, and you can see that in the two-year yield, right? It's all over the place, right? You look at when the, you know, Fed start talking, right? It's down going into the meeting, it's up, now it's reverting. So it's outside of our control. You don't know where the 2-year is going to end up. Will it be at 3.5? Will it be at 3.3? Will it be at 3.8? It's a binary event. It's outside of our control. You can have an opinion. You can say, well, I don't know why Fed will pivot. You know, I think they're just going to stay hawkish, and hence interest rates are going to go higher. Totally fine. You can have that opinion. You can invest money based on that opinion, but you just don't know. What you do have control is your thoughts and actions, right? You can have a control over your thoughts and actions. Action is number of position size, and how much cash you have. And based on your opinion, you're making sure that if you do invest, if the trade's going against you, you're not going to lose more than 4%, 2.5% per position. So those are very important concepts: negative visualization, fight or flight response, dichotomy of a control,